Welcome, everyone. Today, we are diving into something super important for anyone wanting to understand the stock market better. We are going to explore the volume indicator, which is one of the most powerful tools in trading. By the end of our discussion, you will understand what the volume indicator is, how to read it, and how you can use it to improve your trading strategy. You will even learn a few new tricks that can make your trades much more reliable. Let us jump right in. Have you ever wondered how traders can tell if a stock is about to make a major move or if a trend is losing steam? One of the most powerful clues lies in volume, which acts like the pulse of the market, showing us the level of interest and activity in a stock. So what exactly is the volume indicator? It is the number of shares or contracts being traded during a specific time period. Think of it as a measure of how many people are buying or selling. If a lot of people are trading a stock, it means the volume is high. And if very few people are trading it, the volume is low. This gives us insight into how much interest there is in that stock at a given moment. Volume patterns are often combined with chart patterns to provide more context. Let us explore some of the common chart patterns that traders use together with volume to make better trading decisions. One popular chart pattern is the head and shoulders pattern. This pattern can signal a reversal in a current trend. It is made up of three peaks, with the middle peak being the highest, forming what looks like a head with two shoulders on either side. When the volume decreases as the pattern forms, it confirms that momentum is slowing down and a reversal is likely. You will often notice that after the right shoulder forms, a break below the neckline with rising volume is a strong confirmation of a bearish reversal. The opposite is also true for an inverse head and shoulders, where the pattern forms at the bottom of a downtrend and signals a bullish reversal when price breaks the neckline with increasing volume. Another important pattern is the double top or double bottom. In a double top, the price tests a resistance level twice and fails to break through. This forms a pattern that looks like two peaks at roughly the same level. If volume is lower on the second test, it means that buying strength is weakening, which supports the idea of a reversal. A strong drop in price after the second peak with rising volume often confirms the reversal. For a double bottom, the price tests a support level twice and fails to break below, signaling a potential uptrend, especially if volume increases on the second test. If the price breaks above the resistance level formed between the two bottoms with rising volume, it is a strong bullish signal that the trend may be reversing upward. Another useful pattern to understand is the rising wedge or falling wedge. A rising wedge forms when price moves upward but within a narrowing range, with higher highs and higher lows converging. This pattern typically signals a bearish reversal, especially if volume decreases as the wedge forms and then increases during the breakout downward. Conversely, a falling wedge is a bullish reversal pattern that forms as price moves lower within a narrowing range of lower highs and lower lows. If the price breaks out of the wedge to the upside with strong volume, it confirms a potential reversal. Additionally, there is the triple top and triple bottom pattern. The triple top forms when price tests a resistance level 3 times and fails to break through, signaling that the upward momentum is exhausted. If the volume is lower during the second and third peaks, it indicates weakening buying pressure, and a reversal is likely if price breaks below the support level with strong volume. Triple bottom is the opposite, with price testing a support level 3 times and failing to break lower, often signaling an upcoming uptrend if volume increases when price breaks above resistance. By being familiar with these chart patterns and paying attention to volume behavior, you can significantly improve your ability to anticipate potential market movements. Volume plays a crucial role in validating these patterns, as it confirms the strength or weakness of the price movement. Keep practicing these patterns on your charts and make sure to always analyze the volume to understand the complete story of what is happening in the market. Another useful chart pattern is the triangle pattern. There are three main types of triangles: ascending, descending, and symmetrical. An ascending triangle forms when the price creates higher lows and meets a flat resistance level. If volume increases when the price breaks through the resistance, it confirms the breakout. A descending triangle is the opposite, where the price creates lower highs and meets a flat support level, and an increase in volume at the break confirms the downtrend. A symmetrical triangle can break either up or down, and the direction of the break combined with rising volume gives a strong indication of where the price will go. There is also the flag and pennant pattern. A flag forms after a strong price move, usually accompanied by high volume, followed by a short period of consolidation with lower volume. When the price breaks out of the flag, you want to see volume increase to confirm that the trend is continuing. A pennant is similar but forms a small symmetrical triangle after a big move. Like with flags, an increase in volume at the breakout is a good signal that the move is likely to continue. Cup and handle is another pattern that traders often watch for. The cup is a rounded bottom pattern, and the handle is a short consolidation that follows. If volume increases as the price breaks out of the handle, it is a strong confirmation of an uptrend. This pattern is often seen in bullish markets and can provide a great opportunity for entry. By understanding these chart patterns and combining them with volume, you can get a more complete picture of what the market is doing. Each of these patterns has its own story about the balance of buying and selling pressure, and volume helps confirm that story. Keep practicing identifying these patterns on your charts, and remember to always check the volume to confirm what you are seeing. Now, why does this matter? Imagine the stock price is moving up or down. Volume can tell you how much energy there is behind that move. If the price is rising and many people are buying, that means there is a lot of support for the price increase, and it might continue to rise. However, if the price rises without much volume, it may indicate a lack of genuine buying interest, suggesting that the move could be weak and prone to reversal. Similarly, when price falls with high volume, it means sellers are dominating, and the downtrend is likely to continue. On the other hand, if the price drops with little volume, it might not be a strong move, and a reversal could be on the horizon. Understanding this can make a big difference in how you decide to buy or sell, as it helps you differentiate between solid moves and those likely to fade away. Let us take a closer look at how to read the volume indicator. When a stock price goes up along with increasing volume, it usually means that the trend is strong. It means that the buyers are backing this move, which is a great sign for anyone who is thinking about buying. The same thing is true when the price is going down. If the price drops and the volume goes up, that means there are a lot of sellers, and the downtrend is likely to continue. But what if the price is moving, but the volume is low? When the price moves and there are not many people involved in the trade, that is a signal that the price might not stay at that level. It might even reverse soon. So always remember to pay attention to volume and see how it changes as the price changes. This will help you understand whether a move is strong or weak. Now here is something exciting, and it is called a volume spike. A volume spike happens when suddenly a lot of people start trading a stock. The volume jumps up much higher than normal, which means there is a lot of interest all at once. This can happen during times when companies announce big news, like earnings reports or other major updates. When you see a volume spike, it often means that the price is about to make a big move. Let me ask you this: have you ever seen a stock price suddenly move a lot after news comes out? That is often connected to these spikes in volume. Here is an example. If the price of a stock breaks above a key resistance level and you see the volume jump up, it is a strong sign that the buyers are in control and that the price is likely to keep going up. On the other side, if the price falls to a support level and you see a volume spike, it means sellers are stepping in and a reversal might happen. Volume spikes are key signals for major moves in the market. Another thing to understand is how volume helps confirm trends. Let us say the price is moving up. If the volume is also increasing, that means the trend is strong and the buyers are in control. This is often a positive signal for continuing the trade or even entering a new position. If the price is dropping and the volume is increasing, it means that the sellers are in control and the downtrend is likely to keep going, which is a strong bearish signal. However, when volume starts to diverge from the price trend, it can provide crucial information. For instance, if the price is rising but volume is decreasing, this could indicate that fewer traders are participating in the upward move, suggesting that the trend is weakening. A similar situation occurs when the price is dropping but volume is decreasing. This could mean that the selling pressure is fading and a reversal may be on the way. Another important scenario to watch for is when volume drops during a strong trend. If you see the volume start to drop during an uptrend or downtrend, it could be a warning sign that fewer people are participating in the trend. This suggests that the current trend may be losing its strength and could be about to reverse or enter a period of consolidation. A drop in volume during an uptrend might indicate that the buyers are becoming less interested, which can lead to a reversal or a sideways movement. On the other hand, in a downtrend, if volume starts to drop, it could be an early sign that the sellers are losing momentum and the price may stabilize or start to move upwards again. Another interesting pattern is to look for volume divergences, where the price trend and the volume trend do not align. For example, if the price is continuing to make higher highs but the volume is decreasing, this divergence might suggest that the uptrend is not as strong as it appears and a reversal could be near. The same principle applies in a downtrend when price continues to make lower lows, but the volume decreases. This divergence might indicate that sellers are losing strength and a bullish reversal could be around the corner. Paying attention to these divergences can help traders anticipate changes in the trend before they happen, allowing for more strategic decision-making. Breakouts are a big deal in trading, and volume can help you confirm whether they are real. When a stock breaks above a resistance level or drops below a support level, you always want to see the volume increase. Why is this so important? Because it shows that there is real buying or selling interest behind the move. If you see a breakout but the volume is low, be cautious. It might be a false breakout, and the price could easily reverse. So always watch the volume during breakouts to make sure the move is solid. Volume is also useful for spotting reversals. If you see a volume spike at a key price level, it often means that the trend is about to change direction. Let me give you an example. If the price has been rising but then hits a resistance level and you see a volume spike, it might mean that sellers are stepping in. This could mean the uptrend is about to end and a reversal could be near. You can also watch for divergence between the price and the volume. If the price keeps going up but the volume is falling, it could mean that the buyers are losing interest and the trend might soon reverse. There are different tools that use volume to give you even deeper insights. One of the most popular is called on-balance volume. On-balance volume works by adding the volume on days when the price goes up and subtracting the volume on days when the price goes down. If on-balance volume is rising along with the price, it is a good confirmation that the trend is strong. But if the price is rising and on-balance volume is falling, that is often a signal that a reversal could be coming soon. Another helpful tool is called the volume oscillator. This tool compares short-term volume to long-term volume. When you see a positive reading, it means that short-term volume is higher and that momentum is picking up. A negative reading means that long-term volume is stronger and momentum might be slowing down. There is also the accumulation distribution line, which helps you see the buying and selling pressure. If the price is rising but the accumulation distribution line is falling, that means that the buying strength might not be as strong as it looks. Let us talk about some trading strategies that use volume indicators. One strategy is to use volume to confirm trends. If you see the price rising and volume increasing, it means the trend is strong and you can consider staying in the trade. If you see the price rising but volume is falling, you might think about getting out soon since the trend could be losing steam. Another strategy is for breakouts. When the price breaks through a resistance level and you see rising volume, it is a great sign that the breakout is real, and it could be a good time to enter the trade in that direction. Breakouts with high volume indicate strong market conviction, while breakouts with low volume can often result in false signals. There is also a reversal strategy. You can look for volume spikes at key support or resistance levels to find potential reversals. Volume spikes at these key levels can indicate that the current trend is weakening and a change is coming. For example, if a price is rising towards a resistance level but suddenly experiences a volume spike without further price movement upward, it could mean that selling pressure is increasing, signaling a potential reversal to the downside. Similarly, if price approaches a support level with a sudden increase in volume but fails to break lower, this could mean that buyers are stepping in, indicating a reversal to the upside. In addition to these, there is also the concept of volume exhaustion. Volume exhaustion occurs when there is a surge in volume, usually towards the end of a trend, indicating that the current move may be nearing its end. For example, during an uptrend, if you see a massive volume spike but little upward price movement, it can indicate that buyers have become exhausted and a trend reversal might be imminent. The same goes for a downtrend, and where increased volume without further price drops may signal that sellers are exhausted and the price is likely to reverse upwards. Another volume-based strategy is to use volume divergence. Volume divergence occurs when the price continues to move in one direction, but volume begins to decline. For instance, if the price is rising but volume is decreasing, it suggests that fewer traders are participating in the move, indicating that the uptrend could be losing strength and may reverse. Identifying volume divergence can help you anticipate trend reversals before they happen, allowing you to exit your position in time or even take advantage of the upcoming reversal. When price and volume do not agree, it is often a major clue that a change in trend is coming. These disagreements between price movement and volume help traders make informed decisions about entering, holding, or exiting trades. By understanding these volume-based strategies, traders can improve their chances of success and be more prepared for potential market movements. One more important point to remember is risk management. Volume can also help you manage your risk better. For example, you can use volume levels to decide where to place your stop-loss orders. If you see a recent volume spike, you might place your stop just beyond that level. If the price moves past that spike, it often means the trend is likely to continue, and it can help you avoid losses. Another idea is to adjust your position size based on volume. If volume is high, the trend is more reliable, and you might take a larger position. If volume is low, it is safer to take a smaller position because the moves might be less predictable. Now let us discuss some common mistakes traders make when using volume indicators. The first mistake is ignoring volume when the price is breaking out or reversing. If the price is making a big move but volume is low, there is a chance that the move will not last and it could easily reverse. Always ensure that significant price movements are supported by strong volume to confirm their validity. The second mistake is overreacting to small volume spikes. Not every spike means that there is going to be a huge move. It is essential to look for a pattern of sustained volume increase rather than reacting to one-off spikes. Look for confirmation in the price action, such as follow-through movements or key levels being respected, before you make any trading decisions. Another common mistake is misunderstanding volume during consolidation periods. During consolidation, volume tends to decrease as the price moves sideways. Many traders misinterpret this as a sign of weakness, but consolidation with declining volume can be a healthy pause before the trend resumes. However, if volume suddenly spikes during consolidation, it could signal an imminent breakout or breakdown, depending on the direction of the subsequent price movement. The third mistake is relying only on volume. Volume is a powerful tool, but it works best when you use it together with other indicators like moving averages, trend lines, or support and resistance levels to get a complete picture. Volume should be considered as part of a broader trading strategy rather than used in isolation. It is also important to consider the overall market context and combine volume analysis with other technical or even fundamental analysis methods to make well-informed trading decisions. So let us recap what we have covered today. The volume indicator shows the level of trading activity, and it helps you confirm trends, spot breakouts, and identify reversals. By paying attention to volume, you can get a better sense of market strength and make better trading decisions. Start by watching how volume changes during important price moves and use it to confirm your trades. Practice reading volume, and soon you will be able to make more informed trades. Remember, volume analysis is an important part of stock market trading, and it can really help improve your strategy. Keep practicing, and over time, you will be able to read volume like an expert and make better trades. If you have any questions, or if there is anything you are still curious about, think about how you can apply this in your own trading, and feel free to discuss these ideas with others who are learning too. That is all for today. Keep watching those charts and pay close attention to the volume. It will make a big difference in your trading journey.